What is up, guys? Welcome back to the channel. Today we take a look at the 10 biggest market crashes. Be sure to leave a like on this video and to subscribe. Also comment down below letting me know that you subscribed so that you can automatically be entered into this month's shoutout giveaway. Coming in at number 1, we have the 1673 tulip incident. The tulip flower was first brought to the Netherlands from Turkey in 1593. It was then that people started going crazy over the tulip flower, and as you may have guessed, the price of the flower rose and rose more. And why these flowers were so sought after was simply because of their beauty, and some of the tulips even had multicolored petals, which made them be even more stunning and sought after even more. Tulip bulbs became so pricey that people were selling off their land and houses just to buy tulip bulbs so that they can grow tulips and resell them and make huge profits. However, with everyone doing this, eventually there was no one left wanting to buy tulips at such a huge price. There was more people trying to sell them than they were trying to buy, and so tulips decreased in price drastically, causing the market to crash and causing tons of people to lose everything. Coming in at number 2, we have the 1711 South Sea bubble crash. In 1711, the South Sea Company, which owned thousands of slaves, had a goal of making a deal with the Spanish plantations in Central and South America to supply 4,800 slaves per year for the next 30 years. However, they had to buy the contract from the British, as they was the ones who had a contract with the Spanish, and so they did, for £9.5 million. After purchasing the contract, the South Sea Company thought that this would open up huge profits for them. And apparently so did a lot of people, because investors began pouring money into the company, in which the company's stock value raised 10 times the amount it was before. However, within just a few months, due to investors paying too much for stocks in the company was ruined and their stocks crashed, causing thousands of investors to lose their money. Coming in at number 3, we have the 1873 stock exchange crash. The Vienna Stock Exchange that took place in May 1873 caused thousands of Europeans to lose out on a lot of money. So much so that the crash affected the emperor at the time and even affected the imperial family. And the reason behind the crash was simply because uncontrolled speculation caused a massive fall in the value of shares, which made investors panic and quickly sell their shares. Coming in at number 4, we have the 1929 Wall Street crash. During the 1920s, the U.S. stock market saw a rapid growth and eventually reached its peak in August 1929. However, by that time, wages were lowered and unemployment was on the rise. And people who were unemployed tried every which way of getting money to feed them and their families. So loans were taken out at banks and never paid back, and shareholders was selling off their stock. However, it wasn't until early October that the stock prices started to drop, frightening even those with a job and causing a panic, which resulted in all of the stockholders to begin selling their stock. By October 29th, investors were selling stock faster than the clickers could keep up with. Even NYCE saw a record-breaking 16.4 million of their stock sold in a single day. The Rockefeller family tried saving the stock market by purchasing large quantities of stocks, but when the dust settled, the market had crashed and lost out on billions of dollars, which was the beginning of the Great Depression. Coming in at number 5, we have the 1987 Black Monday. On October 19th, 1987, stock markets from around the world suffered drastic price drops, including Asia, the United States, Spain, the UK, Hong Kong, and Canada. The reason behind this was never really determined. However, speculators claim that it was due to the price drop in oil, but others say that it was due to the tension rise between the United States and Iran. Coming in at number 6, we have the 1998 Asian crash. The 1998 Asian crash was simply due to Asians' rapid growth of debt, which concerned investors, causing them to sell their stocks, which would eventually lead to Asia and surrounding countries to lose out on over $100 billion due to a decreased value in their currencies. Coming in at number 7, we have the 1990s dot-com crash. In the late 1990s, one of today's greatest inventions came about, and that was the internet. And as a result, many companies started up online, and even brick and mortar businesses began selling online as well. However, foolish investors believed that any company that was selling online with the .com at the end of its HTTP website link was going to be a very successful business. So investors started dumping money into anything and everything with .com at the end of it. And due to these investors causing stock to be overpriced for smaller companies, a lot of those companies failed, and by 2002 nearly all the companies that investors invested in had failed, which ended up costing investors $5 trillion. Coming in at number 8, we have the 2008 financial crisis. In 2008, for the first time, history nearly repeated itself because we literally almost seen the Great Depression once again. The reason behind this was because banks made their mortgage and personal loans affordable by nearly everyone and started crediting interest-only loans. The Federal Reserve then upped the Fed funds rate, which caused the bank's values to reset. So then people were stuck with mortgages and loans they couldn't pay, and even worse, house values decreased drastically at the same time, so people couldn't sell their house or pay it off. So the only thing left was to lose it back to the bank. However, thankfully, national governments stepped in and helped pay bailouts off and kept the stock market alive. Coming in at number 9, we have the 2010 flash crash. In 2010, the U.S. stock market crashed. However, the crash only lasted for 36 minutes, in which stocks nearly plummeted, and millions of dollars was lost. The strange thing is no one really knows why the Securities Exchange Commission, or SEC, stated that it could have been from a large automated sell order. However, speculation believes that the crash was due to a cyber attack. Coming in at number 10, we have the 2015 Chinese market crash. On August 11th, 2015, Chinese stocks began to decrease in value due to a weak outlook for China growth and a drastic devaluation of Chinese currency. This led investors to doubt their investments and to sell out their stock. And as a panic occurred and stock value decreased, the mainland lost nearly $3 trillion off their value in just 3 weeks.